Okay, picture this. You're sitting right in the CEO's chair, and you're facing a massive company-defining financial decision. You've got to decide whether to authorize the purchase of millions of dollars in new machinery. So the question is, would you spend hundreds of thousands today just to save a fraction of that tomorrow? I mean, on the surface, it sounds like a totally simple question, right? But answering it correctly, that literally determines whether a business thrives and grows or slowly bleeds cash and goes completely bankrupt.
This high-stakes prediction of the future is what financial experts call capital budgeting. Basically, it's the process of planning expenditures where the returns are going to extend well beyond a single accounting year. It's all about committing serious resources right now, matching long-term benefits to your initial costs, and ultimately maximizing the firm's overall profit. You're essentially placing a massive, carefully calculated bet on the future. So today, we're decoding capital budgeting to uncover the manager's ultimate toolkit. In this explainer, we are going to demystify exactly how major corporate investments are truly appraised in the real world. We'll cut right through all that complex accounting jargon and explore the actual math behind the magic. Let's get into it. Okay, let's dive into this. Here is our roadmap for today. We'll start with the manager's big dilemma and gathering the right data. Then we'll explore 3 specific tools: the payback period, the accounting rate of return, and net present value, right before we make the final call. Section 1. The manager's big dilemma, predicting the financial future. Expanding a company's assets is never just some routine clerical task. Oh no, it's a really complex, high-stakes managerial puzzle that requires a brilliant mix of engineering, economics, and cost analysis. Capital budgeting commits significant resources into the distant, entirely unpredictable future, and it requires an indirect forecast of your future sales. Think about it. If a firm underinvests because they're being too cautious, they lose productive capacity and miss out on crucial sales. But if they overinvest, well, suddenly they're burdened with heavy, entirely avoidable expenditures that just drain their cash flow. Plus, capital budgeting dictates the proper timing of acquiring these assets and demands huge upfront funding that usually means securing outside finance way in advance of the actual purchase. Section 2. Gathering the right data, finding the numbers that matter. Now, before a manager can even think about choosing an investment tool to evaluate a project, they absolutely need the right numbers. If you use the wrong data, it ruins the analysis before it even begins. So what's the golden rule? Only future costs are relevant. When you're doing your math, you've got to include expected future savings. Things like reduced scrap material or maybe lower labor costs from a much more efficient machine. You also absolutely must factor in opportunity cost. That's the loss of alternative income you could have made if you did something else with that space or that money. And of course, you've got to include your interest cost, because that sets your minimum acceptance criterion for the project. But perhaps most importantly, you have to ignore sunk costs. Seriously, the unabsorbed book value of some old broken machine is just financial spilled milk. We are only looking forward here, setting up a completely pure foundation for our math. Section 3. The payback period method. The speed test. You can think of this first tool in our toolkit as basically a speed test. It measures exactly how fast a project recoups its own initial cost straight from its generated savings. Let's look at a really fantastic real-world case study from the source material Koki Nigeria PLC. They want to automate some manual labor, and they are pitting 2 alternative machines right against each other. On one side, we have Machine Damsel. It costs 300,000 naira and has a 10-year lifespan. On the other side, we have Machine Shylock, costing a much heftier 500,000 naira with a 12-year lifespan. So, which one is the better buy for the company? And this brilliantly illustrates the payback method in action. We just take the initial cost and simply divide it by the annual net savings after tax. Machine Damsel generates 60,000 naira in savings every single year. So that means it entirely pays for itself in exactly 3.3 years. Shylock, on the other hand, well, it generates more annual savings, over 79,000 naira, but because of its much higher initial cost, it takes 4 full years to pay back. So under the strict rules of the payback method, Damsel crosses the finish line first and becomes the highly recommended purchase. Now, this method is incredibly popular all around the world, mostly because it's just so easy to understand. It uses objective, actual cash flows, and it reduces the risk of long-term obsolescence by strongly favoring those really quick returns. But there is a massive, glaring flaw here. It completely ignores any cash flows or profits made after the payback period. Like, Machine Shylock might go on to make millions in years 5 through 12, but this method literally does not care. It ignores the whole picture. Plus, it completely ignores the interest factor and the time value of money, which definitely necessitates adding a second tool to our belt. Section 4. The accounting rate of return, or ARR, the holistic average. So this tool bravely attempts to fix the payback period's biggest blind spot by looking at the entire economic life of the project, not just those first few years. The accounting rate of return method takes a much wider view using three pretty simple steps. First, you add up all earnings after depreciation over the entire life of the project. Second, you divide that total by the project's economic life to find your average annual earnings. And finally, you divide those average earnings by the capital you invested to get a really clean percentage return. But definitely notice a key difference here. Unlike the payback method, which relies on raw cash, ARR uses net earnings straight from the accounting books. While AAR is beautifully holistic, it takes all savings over the entire economic life into account, it absolutely has its own severe limitations. For one, it relies on highly subjective accounting profits rather than objective hard cash flows. It can also produce wildly different percentage rates depending on whether you define your investment as the initial cost or the average capital over time. But its true fatal flaw? It treats a dollar earned in year 1 the exact same as a dollar earned in year 10. Just like payback, it still completely ignores when the cash actually arrives in your bank account. Which leads us to this fundamental philosophical anchor from our source text: a sum received today is worth more than the same sum to be received tomorrow. This right here is the absolute core reality of finance. Because of inflation, business risk, and the simple ability to earn interest, time itself has a literal price tag. To make the best decisions, we really have to shift our paradigm. Section 5. Net present value, the ultimate boss of finance. This brings us to discounted cash flow techniques. These are the tools that finally accurately account for the time value of money, literally translating time into hard math. Let's look at Garco Industries. They wanted to buy 10 delivery vans for 300,000 naira upfront in year 0. These vans generate 60,000 naira in savings every single year for 6 years, plus another 60,000 when they're finally sold for scrap at the very end. Now, if we just added that up, it looks incredibly profitable, right? That's 420,000 total back on a 300,000 investment. But wait, we must discount those future savings by the company's cost of capital. Let's say it's 15%. Why? Because money in year 6 is worth far less to us than money today. Notice how the discount factor drops rapidly from 1.000 in year 0 all the way down to 0.432 by year 6. When we multiply the expected cash flows by these shrinking discount factors, we get the true present value of those future returns. So the crucial point is the final calculation. When you add all those discounted present values together and then subtract the initial $300,000 cost, you get negative 46,980 naira. That's a negative net present value. The math tells a really sobering story here. Despite looking highly profitable on paper under the simpler, more traditional methods, Garco Industries should absolutely reject this project. It simply does not clear their 15% hurdle rate when you actually factor in time. Section 6. Making the final call. Equipping the toolkit. As a manager, you have to choose between these distinct lenses when staring down a massive financial commitment. Here's what you should really take away from this explainer. Traditional methods like the payback period and accounting rate of return are incredibly popular for a reason. They're simple, they're fast, and they give you a quick, dirty snapshot of project risk and average profitability. But they risk ignoring the fundamental truth of time. Discounted cash flows, specifically net present value, are vastly superior because they reveal the true weight of the future. They respect the reality that time changes the value of money, ensuring you don't accidentally make a multi-million-dollar mistake. Thank you so much for joining me for this explainer. I really hope you now look at the businesses around you and wonder exactly how they make their biggest bets. Which brings us to our final thought for today. If your company's future depended on one major purchase, a purchase that dictates your capacity, your cash flow, and your survival for the next decade, are you just counting the days to pay back, or are you valuing time itself?